Hi, this is a discussion of the S&P 500. I start out with a black box strategy, which will help you to, if you're not interested in the fundamental justification for the strategy, you can just directly implement that black box strategy. And the second part, I'll have the fundamental discussion and a little bit of a valuation theory discussion as well. All right, so the first part of the strategy, it has to be very technically driven. And so here we're looking at a chart of the S&P 500 index, and you can see this chart starts in 1950, and you can see, and then of course this is a very long-term uptrend in the stock market. And you can see here this is the 2000 internet bubble top. Then you have this top, which is the 2007 credit crisis top. Then you have the 2009 first quarter. 2009 first quarter bottom after the credit crisis sell-off, and then you have this dramatic resumption of the long-term uptrend. And so you have to see it for what it is. It's an assumption of the long-term uptrend, and all this volatility was just a kind of an interim pause. So as we follow this long-term uptrend, we can see that the most recent phase of this long-term uptrend has begun from this low, which is in January of 2016. So if you're pondering the question of whether this long-term uptrend is over, obviously it can't be over unless the most recent phase of that uptrend from January 2016 is itself over, because the trend cannot complete unless the last segment of that trend is complete. So what we're going to do now is we're going to zoom in to this price action here to examine the likely status of the trend of that particular segment of the trend that began from January 2016. So I'm going to zoom in to, I will zoom in just to first through a 5-year chart, which shows you this is that consolidation, and this is the January 2016 low. And then you have this further resumption of the uptrend. You can see a little bit more detail here. And now I'm going to zoom into a 2-year chart, where once again you can see that same January 2016 low, and then we go up from here, right? And so you can see this continuing uptrend. And what is interesting here is you will notice that when you look at the price action of January 2016 all the way up to here, which is early November 2016, there is a qualitative difference in the manner in which the price action is unfolding. The ranges are a little bit wider. You can already see that from eyeballing this section of the chart. Once you look at the post-election price action, you can see qualitatively there's a difference in that the ranges are much more tightly packed. I haven't done this analysis quantitatively, but I'm pretty sure that if you do a trading range analysis, if you do an indicator like average true range, I'm pretty sure that it will show that range to have started to come down post the November 2016 low and the rally from here in this phase of the rally. So anyway, this is just some casual banter on what the price action looks like. The important point is we have to get down to the specifics of the strategy, and therefore once again in this close-up view of the market of the price action, the question becomes, is this uptrend over? I mean, you've got to take a decision whether you want to buy or you want to sell or just stand aside. And so the important question there in that context is this uptrend over? If it's over, then probably you want to either sell or you want to stand aside. But if it's not over, you want to be buying. All right. So when I look at this, this is where the black box part of it comes in. My sense is that this trend is not over. Okay. And since an uptrend is a sequence of higher highs and higher lows, what that assessment that I just made implies is that the sequence of higher highs and higher lows must be maintained, must be continued, which means that any low that forms from today, which is today's the 8th of today is a Saturday actually, so 7th of July being the last trading day, which is the Friday, any low that forms after this cannot go below the low. And I'm going to zoom in now to a 1-year chart so we have a little bit more detail. All right. Okay. So what I'm saying here is that any low that forms after today cannot go below the low that we made on the 16th on, is this the 16th or is this the 18th? The low of the 18th of May, which is 2352.72 on the S&P 500 index, the cash index. This cannot be penetrated on the downside if my hypothesis about a continuation of the uptrend is correct. And so therefore our stop loss is going to be placed just below this low. Okay, and obviously our strategy is going to be to go long, because our view is that the uptrend is still intact and it's going to continue to make higher highs and higher lows. And so the other thing, since we know that an uptrend is a sequence of higher highs and higher lows, we know that the low cannot go below this point of May 18th, and we know that eventually a high above the all-time high of 19th June, which is 2453.82, will be made. All right. So the question now is, in between this high and this low, where do we buy it? Should we buy it now? That's the other decision that we have to take. Should we buy it now with a limit or with a market order, or should we wait to buy it at a lower price with a limit order? My answer to that question is we should use a limit order, because, and here's where the retracement calculations come in. You take this low here, 18th May, the high on 19th June, you plot them here. Just waiting. Okay, if you plot them here, this is what you get: 2352 the low, the high is 2453. I'm just rounding off here to the downside, and here you get the retracements. What you've seen so far is a retracement just a little bit less than a 50% retracement. That's what you've seen. And I think what's going to happen, the reason I'm recommending the use of a limit order to enter the long position, is I believe that you have a very good chance now of testing this low of 2391.34. So on the futures, when you implement the strategy with futures, your entry level should be 2391.5. 2391.5 is a good enough entry level. And I think that there is a pretty good chance. This is a little bit of an intraday chart. It's a 15-minute chart. You can see the same. This is the low of 18th May, and this is the of 19th June. Okay, and so what I'm saying, when you look at this short-term price action with the 15-minute chart, is what I'm saying is that the little corrective decline that began from 19th June is not complete as of 7th of July, and it will go below the 2400. It will go and test the 2391.34 level that I've mentioned here on the cash index, and but it will not go below this low. So the idea that would be to buy it around the 2391.5 with a stop loss below this level, the 18th May low, and which is 2352.72. So your stop is 2352.5 on the index, and play for a break above the all-time highs around 2454 and march up to even higher levels. Okay, so this is the black box strategy. This is what you want to do, a specific strategy, and the risk should be, as always, in general, we don't risk more than 1% of account equity on any given trade. And so if your account equity is not sufficient to put this trade on with the futures contracts, that is the E-mini S&P 500 futures contracts, you can alternatively put it on in many other ways, by buying options, by buying call options. When you see this move on the cash index down to 2391, you can buy call options on the SPY ETF. That's the cash market ETF. You can buy options on that, or you can buy the cash market ETF itself. That would be a spot market or a cash market implementation of this view via the ETF. So there are many ways you can do this. So that's the end of the strategy portion in terms of what you would do very specifically, and it's a kind of a black box or at least a gray box strategy, because I'm not going too much into the detail of why specifically I have this view that the market is going to go higher. All right, so now we'll move on to the fundamentals, the fundamental discussion of the market outlook. And one of the things you might have noticed here is that as the market has been, let's go back to a slightly more longer term view of the market. Let's look at a 5-year chart. And you would have noticed, if you're following the market commentary, that as the market has, why don't we go even, oh, this is fine, 5 years. As the market is kept powering higher, especially after the election of November 2016, there has been a literal cacophony of, I'm going to use this text file for a while as I try to make my points. There's been literally a cacophony of protest almost from the fundamental analysts and strategists, every one of whom is saying essentially that the S&P 500 is massively overvalued. I mean, literally every day you get a couple of articles and a couple of strategists talking about how the market is massively overvalued, and this cannot go on anymore. The market is going to crash. And every time the market tends to fall a little bit, these guys come out of the woodwork shouting even louder. But yet eventually the market just keeps powering higher. Now I've been following markets from 1989, and I have never seen so much disconnect between the price action and the strength of the trend in a particular direction and the consensus opinion as on the question of fair value or the fundamental value of the underlying asset. So this is a really sort of egregious divergence between those two entities, or those two factors or facets of the market. And I believe this is one reason why we should expect this uptrend to continue for quite a bit longer, because this is basically not a sign of a market top when so many strategies, I mean 95% of the strategists I think are very, very bearish on the S&P 500. They feel that the market is very overvalued. And if the market keeps on going up when no one really understands very well why it's going up so strongly, that's a good sign that the market's going to keep on going up for quite a bit more. So I wouldn't worry about a market top at this point, just based on this kind of qualitative assessment. Now let's have a discussion on this whole fair value talk that goes on in the market. So what we're talking about is fair value versus price. Now remember, in a fundamental analysis paradigm, because in a technical analysis paradigm you don't care about fair value. You think that price is the fair value. Okay, so any kind of fair value versus price discussion, what you're doing is you're looking at the price, which everyone can see, but you're saying the price, I don't agree with the price. I think that there is something called a fair value, which I can figure out by making my projections about the future earnings. And then I'm going to compare the price to the fair value, and if the price is above the fair value, I'm going to sell it, or at least I'm not going to buy it. I won't buy it. And if the price is below the fair value, I'm going to buy the market. So that's the paradigm, okay? And one of the things you have to notice is how people talk about this concept of the market is overvalued, the market is undervalued. This is actually not good terminology, because what they really mean when they say the market is overvalued, what they really mean is that the market is overpriced relative to my estimate of fair value. That's what they really mean. The market is overvalued is not a correct expression. But anyway, everyone's gotten used to it, so you're not going to change people, change their habits. But you got to understand that market is overvalued really means that the market is overpriced relative to my estimate of fair value. Okay, so what is fair value? And so here we're trying to get into this question of let's try and understand the market. If we assume that the market is efficient, if we assume that this entire level of the market is not overvalued, if the market is fairly valued, what is the market really saying in terms of with respect to its expectations on earnings, on the cost of equity, on interest rates, relative to where we were when the market was at this time, at this kind of juncture, which is when we did not have a great deal of clarity on what would happen with the election. So relative to this period, what is the market saying now? Now if you look at the valuation framework, the market tends to use a lot of these frameworks like enterprise value, etc., especially in M&A. I'm not a fan of these convoluted methods because I think they're really, really complex. and then you deduct the market value of debt. Now, why would you deduct the market value of debt if you are in a fair value versus price paradigm where you don't trust the fair pricing of assets? Why would you deduct the fair value of debt? So there are all kinds of conceptual complications. What I prefer to use as a simple model of fair value of stock, of common stock, is that the fair value, or the fair value is the present value of future earnings, which is a profit after tax, discounted using the cost of equity. Okay, so even this business of free cash flow to equity, I don't like those kind of methods because those are very convoluted, and I think that the room for error is much more compared to a forecast of earnings. I mean, who knows what the capex is going to be? You know, I mean, just talk about being convoluted. I mean, I hate anything which is too complex and too convoluted. So simple model of fair value of stocks, present value of future earnings discounted using cost of equity. Okay, this is our estimate of fair value, and what we're trying to understand is, what if the market is fairly valued? What if the market is efficient, and what does that say about the market's expectation of future earnings and the market's expectation regarding the cost of equity? So as we say, fair value is a ratio. Okay, if we take a very simple example, we can assume that we're going to make some simplifying assumptions that, let's say, the company is going to distribute its earnings after 5 years, and it's only going to have earnings after 5 years. So there's an earnings figure 5 years forward, and you discount it with the 5-year cost of equity. That gives you a simple numerator-denominator kind of structure for fair value, where the future earnings are in the numerator, denominator is the cost of equity. But of course, in real life, the true fair value model is a multi-period model where you have earnings in each period, and you sort of present value each of those earnings, and you sum them up, and then you get the fair value of the equity. But the simplification that I just did, it's not going to affect the substantive argument that I'm going to make. So if the fair value is numerator by denominator, numerator is this, denominator is cost of equity, what does it mean? Because if we say that the market is efficient compared to the doldrums of 2015, what is really happening now as we stand in July 7, 2017, and all through the post-election period? What has been happening is the market has kept on ratcheting higher, and if we assume that all the while the market is efficient and the price is fairly close to the fair value, which means the fair value has been ratcheting higher. Okay, the market's estimate of the fair value of the S&P 500 has been ratcheting higher. What does that really mean? What it means, let's say, is, which means the market's estimate of this ratio, which is numerator by denominator, has been ratcheting higher. Now, how can that happen? It can happen, the fair value can rise, either the numerator rises while the denominator is constant. So you see these four options, the four alternatives that might pan out. Okay, I'm not going to repeat it because I'm writing it here. So this is one way that the fair value can rise. All right, so let's look at now, these are the four possible ways that the fair value can rise. Now let's look at the numerator in greater detail, the future earnings, or the PAT. Now the future earnings, we're going to make another simplifying assumption which will not affect the substantive argument, that the future earnings assumes that the company, we're going to assume that the company has no debt. So what we call EBIT, and earnings before interest and taxes, becomes only earnings before taxes, which is the same as your operating income. So here you have this setup, a simplifying assumption. If future earnings are expected to rise, it has to mean one of these four things. Okay, that is, yeah, if the PAT is projected to rise, one of these four things is going to happen. Either operating income has to rise and taxes are constant, or any of these other variations. So basically, future earnings or PAT in a simplified situation where the company has no debt is a function only of operating income and taxes. So if PAT is projected to rise, one of these four scenarios must be taking place, or must be projected. So now come back to cost of equity. Okay, what is cost of equity? If you go back to the CAPM framework, which is the most commonly used framework, I don't personally like it, but we'll use that just to get a picture of what the market might be implying. The cost of equity is a function of risk-free rate plus the beta plus the equity risk premium. Now, if we're looking at the market, we're going to value the market, the S&P 500, we're going to treat it like one company. Then the beta is going to be 1 because the beta of the market is 1, right? So that takes out one factor. So we have cost of equity, the function of the risk-free rate and the equity risk premium. Now, what is the relationship like? Well, the risk-free rate goes up, then the cost of equity goes up. And if the equity risk premium goes up, then the cost of equity goes up as well. The equity risk premium is the difference between the expected return on equities. I'm just going to write that here. Expected return is a very kind of a nebulous concept. I don't like it, but theoretical finance is full of these things. Expected return, I don't like anything that I can't touch and feel. You know, like I like the concept of the corporate credit spread because I can observe it. I don't like things that can't be observed in the real world. Expected return on equity, strictly speaking, the equity index, minus the, let's say, this is not expected because the risk-free rate is known, minus the risk-free rate over the same horizon. All right. So this is what we have over the same horizon. That's our equity risk premium. So cost of equity directly proportional to the risk-free rate and the equity risk premium. So once again, if we go back to this discussion of the ratio, either the numerator rises or the denominator falls, and all these other nuanced variations. So what we are doing here is, in this discussion, we're just talking about what does it mean. We're assuming that the numerator is rising and we're assuming that the denominator is falling, and we're just going to look at what it implies for the market's views if indeed the denominator is falling and if indeed the numerator is rising. So we already saw that if the numerator is rising, so I'll just come back to that. Let me just finish the last part of it, which is the denominator. So if the denominator is to fall, here we have this cost of equity projected to fall. It means, okay, so we have the cost of equity projected to fall, which is the denominator. Now, if that is the case, then either the risk-free rate must be projected to fall or the equity risk premium must be projected to fall. All right, I need to set up this four possible scenarios, but we'll do it just now verbally. Cost of equity, if it's projected to fall, then the risk-free rate must be projected to fall and the equity risk premium remains constant, or the risk-free rate remains constant and the equity or the risk-free rate will fall more than the equity risk premium rises, or the equity risk premium will fall more than the risk-free rate rises, or so therefore overall the cost of equity will fall. So these are the ways in which the cost of equity could fall, and I think that what is actually happening is that I'm not going to go into the discussion of the of my outlook for the U.S. Treasuries, but suffice it to say that I think overall 10-year Treasuries are expected to rise. I would expect the yield on 10-year Treasuries to rise, because I think that the long bull market in bonds from the 1981 high, high in the yield is over, and therefore the balance of risks on the on Treasuries is for bond prices to fall and for yields to rise. So the risk-free rate component of the cost of equity is expected to rise. And so therefore, and as far as the equity risk premium is concerned, I think that it will remain steady, or it might actually fall a little bit. There are also all kinds of complications with the equity risk premium concept as well. but I'm not going to go into that right now. So the balance of the discussion on the cost of equity factor is that I think that cost of equity will actually rise marginally. It will rise marginally, or it will overall stay kind of constant. So the cost of equity is projected to uh, rise marginally, or overall stay constant. Now, what does that do to our ratio? Remember that we had gone to this ratio. There are a couple of possibilities which I put in bold. This, I think, is one of the important possibilities. That is, the numerator is rising while the denominator is constant. The cost of equity is more or less constant, but projected future earnings are rising. All right, that's what I think is one of the main factors driving the continuous elevation in the fair value estimate of the market, if you assume that the market is efficient. And the other possibility is that the numerator is rising more than the denominator is rising. This is a scenario where future earnings projections, the PAT projections, are rising, but the cost of equity is also rising, but the PAT projections are rising more than the rise in the cost of equity. So overall, the ratio is still rising. So now let's go back to the numerator. If you look at the breakdown of the numerator, what is the breakdown of the numerator? Future earnings PAT, in our simplified scenario, it's a function of only two things: operating income and taxes. It's directly proportional to operating income, and it is inversely proportional to taxes. So what we are expecting here is what I think is expected to happen here, which you can understand quite clearly from the scenario, which is that operating income is expected to rise because we are expecting the economy to be very strong on the back of the enactment of the Trump agenda, which is a very pro-business agenda, and optimism has already risen quite significantly. Jobs are also quite strong. You see a lot of interesting indicators like the U6 indicator. We got a jobs report yesterday. The U6 indicator is also falling to, I think almost a decade low. So all kinds of interesting, very positive indicators coming out of the job market. Wage growth not yet emerging, but I think it's probably going to emerge, and that's what the Fed thinks as well. So operating income is expected to rise on the back of this, growing economy scenario. And the taxes are also expected to fall because you know that there is a tax reform, tax cut plan in the works. Of course, we know that there are all kinds of blockages in Congress. They can't even get the health care bill through when they've been screaming about it for 7 years. They can't even get that through. So that might delay taxes. But overall, I think we will see taxes fall. We will see operating income rise. So therefore, this is the most likely scenario that the market is actually supporting through its price action. Operating income will rise and taxes will fall. This will lead to a rise in the numerator, which is the future earnings. Okay, the numerator will rise. Either it'll rise more than the denominator is rising, or it'll rise while the denominator is constant. And the denominator, as we said, is the cost of equity, and that is a function of the risk-free rate and the equity risk premium. And equity risk premium is probably going to be steady to lower, and the risk-free rate is going higher for what I meant based on my scenario that I mentioned for the 10-year treasuries. So that's the setup. Essentially what I'm saying here is that this continuous rally that you're noticing in the market, if you sort of step away from the naysayers and all these people who are screaming that the market is overvalued, what might actually be happening if the market is actually, if you assume that the market is efficient, what might actually be happening is that the market is continuously raising its, as we journey up here in the price action, the market is actually continuously raising its estimate of fair value, which means if you disaggregate that prediction, the market is raising its estimation of operating income. They're expecting operating incomes to rise. It's projecting taxes to fall. It is projecting the risk-free rate to rise and the equity risk premium to be steady to lower. But this this scenario, if it plays out here, it will cause the cost of equity to rise a little bit. But if that is happening, in any case, the numerator, which is the future earnings, is rising more than the denominator is rising, and that's why your ratio is going up, which is the fair value. So that's your fundamental explanation of what the market, if you assume that the market is efficient in a fundamental framework using most of the tools of theoretical finance. So that's the fundamental fair value discussion, and well, let's hope it all works out.